Joining us this morning on Studio 10 is financial expert Dale Gillham. Hi, Dale.
Hello. Finance expert Dale Gillham from Wealth Within. It's nice to see you again.
It's amazing listening to a professional trader who's doing what you're aspiring to do and hearing it firsthand.
Too many people ring me up and say, hey, Dale, I want to make quick money, but it's not about getting rich quick. I think we can go for about 4 hours, but I'm not sure my wife would like that. So
I'd say congratulations for putting your time and effort out there, because you probably don't really have to do it. You're successful traders in your own right.
Thank you very much for opening up my mind with trading.
So of course you can succeed, of course you can, and you're the only one holding yourself back or succeeding, and that feels very empowering actually.
A quick reminder before the show starts that this live stream is an educational tool, and as such your personal circumstances have not been considered. We hope you enjoyed this week's show.
Good evening and welcome to the Australian Stock Market Show. Tonight we'll answer your most burning questions around trading and investing, and we'll get into the charts and explore the stocks that you have asked us to take a look at. Of course, we'll have another great topic for you tonight, which is top 5 dividend stocks for 2021. They may not be what you think. Hello, I'm Janine Cox, and joining me tonight is Dale Gillham, and we're Australia's most trusted stock market educators.
Hey.
How are you?
Oh, I'm fantastic. Hey, on the weekend, I stayed at home on the weekend, and I was cleaning out my garage and everything else, and I was thinking I needed to find something that was in a drawer, and there was with this floating thing with the TV above it with 3 drawers, and I opened the drawer, and guess what I found?
What's that?
2 Santa hats. You know how you hounded me to find my Santa hats and I couldn't find them?
Why is this relevant now? It's 2021, did you realise?
Well, I know, but I only found them 2 days ago.
So if you don't have them at the end of the year, you know who's going to be hopping mad, don't you?
No, but I'm telling you, I'm leaving them there with the candles.
Okay.
So,
I don't think your wife will be happy about you leaving them in that spot.
Well, at least you'll know where they are when you want to get them again. Okay. But there were 2 there, not just 1. I couldn't find them. But anyway, I'm fine other than that.
So our whole pre-show conversation is about that.
Well, you were so distraught that I couldn't find my Santa hats and wear them on the show. So, okay. And everybody watching knows that you are saying, where's your Santa hat?
So were you excited about the market this week?
Yes.
You were?
I was. Actually, it was interesting because, last week I was saying I thought the market would go down. Oh, sorry, before last week. I said I thought last week would be down week. And it wasn't. Well, it was a down week. It started going down on Monday and it went back up again.
But that's not a down week.
But that's not necessarily a down week. And it's interesting how people take information. Even though we say to people, don't take tips, make sure you do your research, know what you're doing.
No one would have traded on you saying that, surely.
Yeah.
No.
Yeah.
Look, you guys out there, whichever station that you're tuning into, the Dale station, he says to you all the time, do your own research. Check whatever you're going to do before you trade it. Do not take tips off people. And we talked about that on our discussion last week, didn't we? We did. We did. But anyway, I need to move into the show anyway. But let's go. But first, thank you for all of those who have actually sent in emails. We did get a couple of private ones. Now, remember, this is your show. So if you do have a burning question for us, don't just sit there. Please take the bullet by the horns or whatever you call it. Bull. That's it. Take action and send us an email. Or better still, upload a 30-second video of yourself. I'd love to see your good-looking dials on our show and just upload them to Dropbox and send us the link. Now remember to send all your questions to info@wealthwithin.com.au and type Wealth Within Live in the subject line. Now, as always, we give preference to those of you who are supporting the show and supporting what Janine and I are doing. So join in on the conversation. Make sure you hit the subscribe button right now to support the show and send your emails in. Moving on, it is the second Tuesday in the month, and this means we get to look at the sectors, yay, and on the Australian market, of course, not the US market. Let's get right into the charts now, shall we?
Oh, fantastic. I get excited about sectors. That's good.
I love this part.
You love charts.
Okay, so we're looking at the S&P ASX. I can't leave the S&P out. ASX 200 sectors. So we're looking at the top now. Now, someone asked us last week, why don't we have the real estate sector on there? Which is a good question, isn't it?
Yeah, you can answer it.
Because it forms part of the financials. So,
correct. It's a subsector within the financials.
Yeah, we could have it on there. I mean, we don't want to be too tough on that, do we?
Yeah.
All right. So information technology is leading the board at the moment still. 5.8%, which is pretty impressive. Financials up 5.2%, happy about that. Consumer discretionary up 4.8%. Consumer service or communication, get it right, Janine, 4.5%. Materials 3.5%. Energy up 2.8%, that's looking good as well. Industrials up 2%. I like it when we see the industrials moving in the right direction. And the healthcare sector up 1%. Consumer staples 0.39%. So this is where we're at so far for the month.
Can we have
and
a
it's
quick
only
look
early
at,
days.
Yeah, can we have a quick look at the year, which is from 1 January? Are we
Yeah,
allowed to
of
do
course.
that? Just because obviously it's only, we're talking about a week into the month at the moment, so that gives you a better idea. But consumer discretionary, financials and communications flying there, isn't it?
Yeah, hasn't that changed things?
Big start to the year where utilities and industrials are down.
Yeah, so Infotech, most of the gains were made in January for Infotech, as you can see, because that's up 6.2%. And consumer discretionary is right at the top there, 9.7%.
Now, you wanted to look at that
financials.
sector, didn't you, the charts of that sector?
Yeah, but like one of the things
staples?
that's interesting, you know how we always talk about the market, if it's up at the start of the week, it doesn't necessarily mean it's going to be up at the end of the week. When we're looking at the sectors, we could make the same sort of conclusion. So the sectors that are up at the top of the leaderboard at the moment may not be up at the top of the leaderboard at the end of the year. That's going to be the interesting thing to keep watching. So perhaps we could do a show and have a look at what's happened in previous years and see how things unfold and whether there's any pattern with particular sectors on the market.
I think we can do that. We can just show them what it is. So you wanted to look at a chart of one of them?
Yeah, I guess you could toss and turn over which one's going to be more important, but the first one that's on our list there is consumer staples is an interesting one because we're talking about the big companies, particularly I'm interested in Woolies and Coles and how they're performing at the moment because they have been in a price war. So if you want to have, are you going to bring up the chart for us?
No, I'm just looking at how they are for this week. So this is everything in the consumer staples at this point in time in that sector. So we're seeing the top producers there.
So what we're looking at there are the lower liquidity type shares.
They're most of the lower liquidity type shares, and obviously this is the other end. So this is the worst performing ones so far this week, and it is only a week. So
and the interesting thing about that is that you could look at it one week, especially with those low liquidity stocks, and then look at it another week, and it's completely different because they can move really quickly. 5, 10, 15% sometimes is not out of the question, even more for some of those types of shares, and then they go the other way just as quick.
But there's some good stocks within this sector that you're saying could be giving us some opportunities.
Look, there are always good stocks in this sector, so it's something that you've got to keep an eye on. And not necessarily just Woolies and Coles, they're two good ones, but at the moment, because of that price war, it doesn't necessarily, if you look at the past, they don't necessarily create growth by having a price war.
Okay, cool.
So that's always a question mark for those companies when they get involved in that type of, seesaw.
Okay, fantastic. So that's it for our sectors for this this month. Actually, we do the sectors for the month, but we will go and look at the sectors and what Janine was talking about, go and do some research and look at sectors' performance at the start of the year, towards the end of the year. But now we're going to get into our first email question. And we have one. Are you giving me a tough name again? I'm going to say this. Apoorva Savai. Now, last week somebody gave me a compliment, so I said their name right. So hopefully I've said you're right. Apoorva says, hello, wanted your opinion on ASX code PRN. The company is doing well. However, the stock prices is not able to break the barrier beyond a certain level. Are you able to give your technical analysis? Further, top 20% hold 89%. Is that good or bad? I think what he means there, the top 20% of shareholders own 89% of the stock. Now, that's not necessarily a good thing, but it can make the stock a little bit more scarce, if that makes sense. If the top, a small percentage of players actually own the largest percentage of stocks and they're not trading them actively, trading them, it can give you scarcity, and it can make the pool of people trying to get that last 20% of the stock or trade that last 20% of the stock, they're scrambling and pushing prices higher. But what are you thinking on the actual stock price at the moment?
It looks okay at the moment. Where it's positioned is a really important level for it, which is why it's been going sideways like it has. So if we get a move above at least $1.50, strong move, That could be really nice for this share. Could just keep pushing higher.
Yeah, it does look right. It's holding up quite nicely. It's struggling to get through that sort of $1.50 sort of area. But is this because that big end, the people, that the major shareholders, are not wanting it to push up higher?
Well, I don't think I'd care too much about that. I mean, looking at the volume, it is all over the place. If you look at the history of it, that's something that's interesting, and it's
So the
dropped
volume
really
down
low.
here, all this down here.
Yeah, there's a lot of volume there, obviously, with the selling that came through, and it's dropped down. It's actually below what probably is an average for volume, but I guess where would you be worried about this share?
I'd be worried if it fell below the low of last week, that big blue bar last week. So if it fell below this, then I'd be looking at exiting this stock, because it would probably come right down to around $1 or even further. That's what I'd be looking at it. So there's some positives and negatives about having a small proportion of shareholders that own a major point, but it's not a bad thing. Okay.
It just means the liquidity issues can occur. Yeah.
Well, that's all for that one.
All right, so the next one we've got is from Neil. Hi Dale and Jenny. I've got a new name.
Who's Jenny?
I've looked at the closing single price action, CSPA, from 4 till 4.12 for many mid to large cap stocks. Good study. They usually have quite stable trading volume for this period of time. For example, always 1 million or 500,000 shares exchanged at a fixed price. Occasionally the volume may go higher when on the next day, and the stock price may make a big move either higher or lower significantly. I mean, does the CSPA volume and price mean anything? If the volume for that time is stable, does it mean there are institutions keep buying or selling, and is it good sign or bad sign? Look, thanks so much, Neil. Is it something you studied? I haven't really studied in great detail the actual volumes going through at the close.
No, but did you want to sort of explain what's actually going on there?
Yeah, so there's actually, it's almost like a bit of an auction really, isn't it?
Yeah.
Because people are putting their bids in to the end of the market to get their stocks sold or purchased if they want to buy. And so with all those bids going in, it's a match off, and it's a weighted match off for the stocks that are, or the stock holdings that are sitting there ready to be traded. So that's what you see. And I guess from my point of view, unless the stock's a little bit illiquid, I don't think it really means anything at all.
I don't think it really means anything, because there's also a bit of the match up with institutions maybe that wanting to buy or sell a stock that haven't got all their trade on that day.
Well, we trade in that period ourselves. You know,
we do it
it's
all the
good to
time.
be able to do that at an institutional level as part of the direct equity managed account service when we're trading for clients. Because often what happens is that the people who are in the know are trading towards the close. So we might be waiting to see what the market does or the stock does at the end of the day, and that just allows us to place the trade.
Okay, well, that's it for that question. But a really good question, and it shows you are thinking about the market and what's going on. But you probably don't need to do as much research on it. It doesn't mean as much for retail traders. But this next question we have is from David. Nice, easy name for me. Thank you very much. Hello, can I have your technical analysis opinion on a chart for Beta Shares Geared US Equity Fund, or GGUS? Please, thank you. GGUS.
Yeah, look, I get really excited about beta shares when I see them with different ETFs, and to be building some of these up. And this one is a hedged fund, obviously, but it looks really good at the moment. So I quite like it. Now the challenge is that last week was such a huge move, wasn't it? An initial fall and then a pushback up, like you said. So now it's a geared one, so you might want to mention something about that and the risks associated with geared type arrangements.
Well, you're looking at whether if it's geared, what's it trying to do? Is it trying to outperform what it's the actual index that it's talking about? So is it gearing from a point of view of what's normally you would go for an index fund, there'll be a beta of 1. If the index goes up 1, then the ETF goes up 1. But is that trying to be a multiple of that? I don't know this one. I've never read the prospectus on it.
Well, that's where it's important for an investor to really understand it. And if you don't understand what they're doing, then you just don't invest in it.
Because gearing costs. There's a cost to gearing. There's a borrowing cost, all sorts of other stuff within there. And they'll wrap it within that fund, so it's not you actually paying for it, but in essence, the investors are paying for it somewhere. But
look, I would just think, looking at the chart, the fact that it's gapped
good.
up like that, it does look good, but it's gapped up before and kept going. You'll notice back here when it did that, this was back in, what is it? Can you see
back in October, November 2020, yeah.
Same sort of thing unfolded, a bit of a sideways move and then a push up. Now, that doesn't mean it's going to do the same thing this time, because the risk is that it could come back to trade within that range. But yeah, but at the moment, it looks nice.
It looks all right. Okay, so that's it for that, or that stock. And the next question?
And now we've got a question from Richard. Now, he says, hi, I'm just wondering what your thoughts are about ABB, Aussie Broadband. I've just discovered your channel and become a big fan. Well, thanks very much for that vote of confidence. Now, let's have a look at this one. Aussie Broadband, of course, hasn't got much data there on the chart. So you can see on the monthly chart, because it's not long been on the market, we've got this 5 months, really nothing to go by from a technical perspective. So this is where we don't trade stocks if they don't have a significant amount of data to be able to form an opinion on what the stock's likely to do in future based on its history. So you can't even really tell what the personality of this share is going to be like, really. It's going to be such a simple theory, like either it trades below last week's bar and you're out.
Which is what I've got my point on,
Yep.
got 232.
Or it actually closes back up strongly above approximately 265 and then it's more likely to keep moving up. I mean, that's just as simple as it's going to get at the moment.
Well, I mean, this one obviously listed on our exchange back in October. Now, 50-50, it's going to trade below its float price. That's what happens
and it's been
with
quite
floats.
strong.
But it's been quite
which
strong.
Which is good.
So
but the 12 months is not up yet. So we say that within 12 months that can happen. So we just need to see whether it's got sufficient buyer support to maintain it above that low of about 230 approximately.
So what you're saying is don't necessarily rely wholly and solely on the technicals. You're looking at what are the announcements, what are the fundamentals, what are their reports. There's reporting season right now.
Look, I think
look at
that's
their first
true
report.
to a degree. However, I just think people often say, well, look, if I try to use the technicals and there's no history, that means that, I'm just really holding my finger in the wind and there's no wind blowing. I'm just guessing, basically. And you are to a degree because there is no history. So it's like when a lot of companies do float, how confident can you really be in what you're being told? Given the data that says. But look, I would say look at it as simply as that if I was holding that share.
Fantastic. So you pick something else to look at, basically.
I would.
Yes. Okay. Well, thanks very much for that anyway. But the next question we do have is, we have a request from Michael who says, hi guys, I bought Whitehaven coal at $1.04 and had a reason to believe that if history repeated itself, this stock could possibly hit $3 plus. Not speculating nor confirming, Dale, just my opinion. My intentions was to hold short to medium term, let profits run and cut losses short. Where have I heard that before? I don't know. Is Whitehaven coal on a downtrend or is it consolidating to move back up again? Thank you, regards, Michael. Can I say something to Michael without being rude to him?
I don't know. It depends what you're going to say.
Well, he should have been asking that question before he bought, not afterwards. And you're either speculating or you know what you're doing, trading on confirmation, or you're speculating. There's one or two.
Well, he's probably speculating, but he's probably thinking, well, I think it's on a trend, but I don't know.
But it's a guess.
And I want Dale to tell me.
And he wants Dale to tell him. So I'm not trying to be rude, but you know what I mean? It's like you should have asked that question before and knowing if you bought in at, what did you say, $3.04, correct? That's what he bought in at?
Yep.
So he bought in somewhere up around here, probably.
Now, of course, it was in a downtrend at the time.
And at that point, it was definitely in a downtrend. So that was to me, if you'd asked me the question, is it a downtrend, uptrend, at that point, I would have said, it's definitely in a downtrend, don't get into it. So.
And what he wouldn't know, because if you studied with us, then you would know that was actually a really critical level for the stock at the time. And it really needed to jump above that to start pushing on and prove to you that it was actually going up when it hadn't proven that.
So he's saying short to medium term. I mean, that was November 2019. So he's had it more sort of a long term. He's obviously didn't have all the rules that he possibly might have right now. And we're looking at it's fallen a huge percentage, down, roughly 70-odd% there. So therefore, we would have said, just somebody reading my book, Accelerate Your Wealth, that they could have had a stop loss on it. So there's two things there. Now, obviously you're still holding the stock. So right now, I think the stock looks good. I'm not sure what your thoughts are, but I think it looks good. It's just got a little bit of weakness the last few weeks. And I think there's probably, is it now in an uptrend? And I think what he's saying is now, because I've got in too early, should I still be holding all this, or is there more downside? And I think if we start seeing some green bars through and move up over the next few weeks, I think he's right. I think it will slowly move back up to where he bought it from.
So that's the question, isn't it? So I don't like it. I mean, I didn't think it looked good when it was coming up here, nice and strongly off that bottom. So short term, I thought it looked really good. And like you say, it just was going sideways and dropped out of that. So that's not a great sign to see it drop out of that sideways move rather than continuing the trend.
Yep.
Because it is in an uptrend at the moment from the, there. But if, for example, the stock started moving up above 170 really strongly next month, then I'd be interested
You'd be excited about it. So
not excited.
Okay.
Because there's always a risk when a stock's been trending down for such long term that it can then turn around and keep going down.
Correct, and there's opportunity cost in him holding.
But that's
for so
the
long.
minimum it would need to do for me right now, given the liquidity and the volatility.
So there's something for Michael to think about what he should be doing, what we think the Michael is. So that's it for Whitehaven Coal.
Next email we have is from Sahib. Hi Dale and Janine, love your show. Thanks for doing what you do. I just had a question about Origin Energy. ORG is the code, and I purchased it at $5.24 at the end of November 2020, and since then it's been quite volatile and has recently dropped heavily following the results. I'm currently in a loss of 13%. I'm close to my stop of 15. What's your opinion on the stock, medium to long term? Thanks.
Very good.
Very nicely written.
Very nicely written. Very, very good question.
Yeah, so at the moment it doesn't look great.
Okay, thumbs down.
At the moment, yes.
Thumbs down. Not looking good. Just stick to your stop loss. I think that's what I would say.
I think that's all you can do, really.
Yeah.
I mean, if it closed up at the end of this week strongly, there's a chance that it might start to recover, but that would be the thing that you would be looking for, and then you'd have to just watch it on a week-by-week basis to see that it was going to turn back up.
I mean, it looked all right through here, but it couldn't get back through that. That's a sign of a weakness.
Well, it's early
through
days
there,
in February yet, right? But if look at the monthly chart. So at the moment, it's pushing that right down on the bottom of that monthly bar, and if it keeps pushing down towards the end of the month, then it's more likely to fall than rise. But I'd just be watching it, watch your stop and watch it at the end of the week as well.
Yeah, I think my thing is, and I know taking a loss on a stock is quite hard, especially if it's the first one. So you really do need to stick to your stop losses, because it's not about whether you feel whether you're wrong or you made a mistake getting into it. It's just protecting the capital that you have. And if you get out and it goes up 3 weeks later, well, then that's what it is. But what you do is, if it keeps going down, it'll make you feel better because you're already out of it, and then you can be in a stock that's going up. I don't know what you'd probably prefer as being a stock going up. Okay, so that's my thought on that one. So that's it for this stock, Origin.
All right, before we get into the topic, we hope that you're enjoying the show so far. We've got lots more to come. And before we get into that, now's the perfect time to make sure you hit that subscribe button and also like the video. Remember, those who email in a video question during the month of February, you'll go into a draw to win a signed copy of Dale's book, Accelerate Your Wealth, and we'll announce the winner at the end of February. Remember, you must email in a video question, so fire up your camera and get talking. Now, we didn't get any videos this week.
I'm so disappointed.
So nobody wants your autograph.
Nobody wants my book.
People want your book.
Oh, they want my book. Yeah, well, I do. I don't know how many emails I've had in the last month of people saying, I bought your book, I've read your book, and now I'm making money, or I'm trading better, all that sort of stuff.
Yeah,
I had one person
awesome.
saying, I used to look at all the stocks on the market. Now I only look at the top 100, and I'm making far more money, and it's taking me a lot less time from reading a $30 book. It's a no-brainer in my bit. You know. But anyway, that's it. That's my being on my high horse.
Now it's time we get into the topic for tonight, which is top 5 dividend stocks for 2021. They may not be what you think. Now, the most common misconception held by investors looking for dividends is that what is needed is to simplify or to simply invest in the highest dividend paying stocks. Retail investors, that means a lot of people who might be watching this show, are largely unaware that there are hidden risks in this strategy and so often fail to achieve what they set out to. Now, selecting good dividend stocks is far more involved than just looking at the highest yield, as dividends are often paid to entice shareholders to hold stocks that are falling in value. Now, remember, you don't need a finance degree to select the best dividend stocks in 2021. You just need a little knowledge, and to help you on your way, we'll share some insights in how to select good dividend stocks in the current market. There you go.
Well, I don't know about you, but it used to peeve me off all the time when I'm doing live sessions and things, and people would say, I've got this stock, why? Because it pays a great dividend. And I was like, you don't understand, do you? We'll change your mind, hopefully. But before we discuss how to select good dividend stocks, you will have heard us say that the most important thing you need to understand when investing in the market is your risk. Now, many investors ignore the risk to get dividend income, but is this wise?
We don't believe it is. Why would someone risk 10, 20, 30% or more of their capital just to get a 2 to 5% return?
Well, I mean, the assumptions that investors make is that the dividend will provide a consistent income. With bank interest so low right now, it is really attractive. But remember, dividends can be cut to zero or change at any time, which has occurred with many stocks. More recently, we saw this happen with the banks, which is something investors never ever thought would happen, nor did most people who buy and hold banks think their shares would fall 60% and be in decline over many, many years. So this is proof that no stock is immune.
And just remember, you don't get something without risking something. So let's explore what's important to consider and the risks investors are taking before we get into discussing how to select good dividend stocks. So look, I mean, that's a whole thought process, isn't it? You know, selecting the good dividend stocks.
Well, yeah, I mean, how often? I mean, like for 10 years, people were saying, to me, they were going, oh, I'm holding Telstra. I go, why? Because it has a good dividend. I said, so you've lost 30% last year to get 5%. That's really smart.
Yeah, I know. But I think people
it's
have
like
been...
a Durr situation. It's like, Durr, what are you doing?
Yeah, I think people have been brainwashed, right, into thinking that they have to get dividends for income.
It is, but
so we've tried to turn that on its head, haven't we, and say to people, well, you don't have to just wait to get paid out a little bit of money every 6 months or each quarter, depending on the stocks that you're buying. You can take that money out of the market whenever you like.
So companies paying, so we saw that with the banks.
But I haven't finished.
Oh, sorry, I apologise. Ladies first.
So, you know, it's all about selling the stock to get a return, and people don't want to crystallise, you know, a capital gain because they're worried about paying the tax. And you're always on about that. So that's why I thought you'd jump on the bandwagon with me there.
Oh, well, I'd rather pay more tax.
Instead.
It's like, I don't know why people are afraid of paying tax. It's like the government's taking their money, but I look at it as the government have all these rules and laws around helping us invest more. So paying more tax is just our fee for being able to make more money. Because we can negatively gear. You can't do that in some countries. We can negatively gear and leverage and make more money and claim all these tax deductions so that we can make more money. And I think that's great. So pay more tax.
Look, companies that are paying high dividends is another topic that came up as part of this whole thing. Now, you and I both have seen what's happened. We've seen situations where companies all of a sudden either have high dividends because the share price is falling.
Correct.
And so the dividend yields all of a sudden change. People jump in thinking they're going to get a big dividend paycheck, and then the company goes and makes an announcement they're not going to pay out that amount. Of course, they're not going to.
Because they haven't got any cash flow to do so.
Yeah,
because that's why their share price is falling.
But no company board in their right mind is going to pay 8% if they're a big company and they don't have to. You know, they know that there's a certain amount of investors that are going to continue to hold the stock. A certain amount of funds are going to continue to have to hold them. So they're going to change it.
And their job is to support the share price as the board. They're trying to hold the share price and grow the share price. So therefore, if they can keep cash from going out in dividends and putting it to supporting the share price.
Well, when the stock's falling, that's the challenge, isn't it? But then the investors could bail out because they're not getting the dividends that they want. So that's the other thing. But the high dividends often mean that the company is high risk as well.
Yeah, now you mentioned...
So think about it. Why is someone giving you, paying you to buy that share, essentially?
They're paying you to take some risk. I think that's what it is. But also you mentioned banks, and you mentioned that companies they suspend a dividend or stop paying a dividend at all. And you mentioned the banks.
Yeah.
Did you want to talk a bit about that?
Well, look, we can. I mean, we can as we go through this, if you like. But I mean, in terms of the banks, you've raised it. So I guess people never thought in their wildest dreams that would happen, did they?
No, they wouldn't. Especially the big four. They wouldn't think that they would drop their dividends.
They would freeze it. And, some stocks froze their dividend through COVID. So if that's the case, then investors can't rely on the interest in the bank, and then all of a sudden they can't rely on the dividends from shares.
How many investors did you see that held bank shares from March, April 2015 for the last 5 or 6 years as the banks were falling away? They just kept holding them.
Yeah, but they probably think, well, I'm just happy to get that dividend check coming in every so often, and then all of a sudden it stops. So that might have been the point that they were really worried about it.
Yeah, but to me it's an either or. Would you rather lose, as you said, up to 60% on some of those banks, which some of them did, and all of them fell over 30% in that time. All of them did. Would you rather get 5% or get 30% on your money? And I guarantee 100% of people say I'd rather get 30% than 5%.
Yeah.
But that's what they're missing out on by not exiting stocks that are falling away, and they're holding them for dividend where they could be getting in a stock that's going up 20 or 30% and getting that.
Well, just on that point, what you've raised is share price direction.
Correct.
So they're purchasing stocks because apparently they have good dividends without looking at the direction the share price is going in. So that's one of the really key aspects of actually selecting the best stocks to choose that are paying dividends. So what's another one?
Looking at you can look at the ex-dividend dates and looking at what goes around those ex-dividend dates.
So that's
Is that
about
what
the
you're talking about?
risk. Yeah.
Yeah, that's around the risk.
Yeah, so sometimes people buy stocks and they think, okay, I'm going to buy the stock, it's got a good dividend, and then the share price drops when the stock goes ex-dividend. Now, in some cases, it's not the end of the world, but in some cases, it can be part of an overall decline and just sends the stock down even further, you know, as part of that continued
Did you want to
downtrend.
explain what ex-dividend actually means for people who don't understand
No,
it?
I think you can, because we had a bit of a discussion about this before the
you're
show.
better. You're better. You're much more simple than I am. Is that a backhanded compliment?
I just zipped my mouth
Zip
right
my
in.
mouth.
So, yep.
Basically, dividends are listed as come dividend and ex-dividend dates, basically. One's before it's paid and the other one's after it's paid. So basically, there's a date where they pay the dividend, and that's what Janine's talking about. It drops after that date.
Yep.
Because you generally see a stock will rise up into the dividend because those people that own the stock are going to get that dividend paid to them, which in effect lowers their buy price. That's all what they're thinking of, or their acquisition price. But after that date, the dividend's already factored in, and you can't buy it to get the dividend then after that date.
Now, we're not necessarily going to go into detail about when that happens and why on the show tonight, but it's more about them going away and being able to have a look at their chart and see and observe what actually happens when a stock goes ex-dividend to the share price. How far does it fall as a percentage on the day from the prior close? And then what happens, you know, in the weeks and months after that.
But that's a really good point. It's about, Pete, for those who are really keen, they really do need to learn about proper process for the stock selection, just not for dividends, but also for their portfolios as well. And you need to invest in yourself. And look, you know, Janine and I will keep banging on, you need to study one of our courses. You know, we cannot do this whole subject of dividend justice in the 10 minutes or so that we have on this show, and I'm sure you really do appreciate it because it really is such an important area. And I know a lot of people say to us, you know, on their emails, hey, I'm learning so much from your show, and we really are a scratcher ticket. We're just scratching the surface on a scratchy ticket. We're not the big prize.
I beg your pardon?
Well, it is the stuff we talk about. If somebody's learning a lot from this show, then there's so much more to learn because it's like an iceberg. We're only giving them the tip of the iceberg, and there's so much more underneath that.
I'm happy with that analogy.
You are? Okay, good.
Yeah.
Thank you. It's much better than that.
To keep this really simple, firstly, let's take a look at a list of dividend-paying stocks in Optima. We'll talk about how to select stocks as well as what to observe before making the decisions. And when you do the course, you'll receive the Optima software. So remember, while it's an amazing software package and one Dale and I have favoured for years and used it since we started, really, didn't we? What the software doesn't do, it doesn't think for you, right? It can filter stocks and give you a list. It can show you charts and you can analyse them. So you've got to narrow down your search as part of your own selection criteria. So that's the first thing you need to be thinking about. When you're looking to select stocks, don't just select stocks because they're paying a good dividend. Go and really do your research. Think about what sort of portfolio am I trying to construct here, and then do your analysis.
All right, so let's get into a list and talk about how to select stocks that pay good dividends, and then we'll look at a couple of examples with you. So let's go into the Optima now and have a good look at that. So what have we got on here now?
Yeah, now look, I mean, the first thing, I think it's a bit small for a start, so
how
you might
about I fix
actually
that
help
where you
that.
keep talking?
Yeah, but the first thing to do is think about where are you going to select stocks in terms of the market. So you've got a huge list of stocks to choose from, and this can often be a bit overwhelming for people when they're attempting to select stocks for their portfolio, whether it's for dividends or dividends and capital growth, and never think about just getting dividends. I've had people say to me, oh, look, I just want income. You can get income in a different way just by being able to buy and sell a few shares in a periodic way, and you don't have to do this short term. It's not day trading. You can do this on a monthly scale. You can be in stocks for 18 months, 2 years, sometimes longer, depending on the rules that you have on the shares that you're trading. When you're looking at big stocks, you know that most of them are going to pay reasonable dividends. But because we've had some decent moves in the share price, of course, when the companies come around to reporting season, they're going to adjust the dividends. So
Correct.
These are reasonable figures that we're looking at right now. So you can see at the top of the list that Dale's got there, this is sorted according to the dividend yield, and it may not be exactly the same as what you might see on your own screen. It just depends on the data that you're looking at and the timing of when the data was snapshotted. So Rio here is showing really good dividend. But the stock's been really extended in terms of its share price more recently. So if the market's paying an average of around 4%, or, approximately, then you know that if you're getting something around that 4% level, it's probably reasonable and it's probably reliable.
Yes.
So when we're talking about the best dividend paying stocks, we're talking about reliability, not the highest dividend return. Now, at the bottom of that list, you can see there that stocks that are typically more growth-related stocks, like the CSLs, the Newcrest, which is a gold stock, even Westpac is down there at the moment. I'm not sure about that figure that's there at the moment. Woolies is got a reasonable return, but as we go higher on the list, and these figures will change as the share prices change, as I mentioned, then you know that these whether you get that return or not is going to be questionable. Now, I remember when stocks like Woodside came out and they pumped their dividend up really strongly. This is right before the mining sector crunched.
Yep.
In the years prior to when the mining sector crunched. So, and often mining stocks will do that when the share price is falling to get investors to take up the stock. And I'm not saying that was their strategy at the time, but we've seen it happen time and time again. Stocks like Woodside, I really like. That's, to me, is a good opportunity. Now, this is only the top 20 shares. I've got another couple of watch lists there, and I'll explain those in a minute. But if you had a portfolio and you were saying to yourself, well, I just want to stick to the big stocks, big liquid stocks on the market, and I'll choose from those. Now, in your book, you talk about how people can use the top 20 stocks and make a return from the top 20 stocks on the market.
Yeah, I do. To me, for me is...
But what part of that is the dividend? Because, if you're able to make it, if, say, a Wesfarmers rises 10 to 15% in a given year, now it doesn't do that every year.
Correct.
But if it does that in particular years and you can make a decent return out of a Wesfarmers, then the dividend's really just not important, is it, in the scheme of things? I
treat the dividend yield as the bow on top of your present. The present is the stock. If it's not a good stock, then the dividend yield is completely irrelevant.
But why is it then we have this whole attitude of, as people get older, they want income, and they're being told to choose stocks to buy to get a dividend?
Because the dividend's being paid twice a year, so it's something that they can push. So brokers can push it out saying, well, yeah, if you invest in this, you're going to get 4%.
But even advisors are telling people that.
Correct, but that's the point, is they're saying don't focus on what the share price is, because then you're going to be focusing on whether your portfolio is growing or falling. Focus on the income that you're going to be getting onto that. And so,
to me, Woodside is a balance between a good growth stock and also offering a return from the dividend. So that's 1 out of the 5 for me.
Yeah, so Woodside's paying, where is it? They're up there, 3.96%. So that's based on today's current price, basically.
Yeah, from time to, we always have this on the watch list, and from time to time we purchase this for our clients. And then Wesfarmers is another one. Like a stock that you can't go past. It's a really good growth stock, but it has a good dividend as well from time to time. And of course, you've got to go for a bank.
Yes.
Right. Macquarie is one that's always at the top of our list.
It's a great growth stock.
Great growth stock, but it pays a dividend. So you're going to get a balance. Don't limit yourself to thinking about the dividends, just the dividends only. And often these shares have fully franked dividends, so check out whether they've got the franking or not, because that can, for retirees, that can obviously help push up the return that they get overall. Yep. But, it's not the be-all and end-all. So therefore, we've got Macquarie, we've got Woodside, we've got Wesfarmers. There's 2 more stocks. Would you like to comment on something?
No.
Okay.
Why do you want me to comment on something? I was just looking at what the criteria is. It's like, to us, it's, number one, you actually said it a little bit earlier, it's direction first. Always go for direction.
Are they rising?
Are they rising or falling? And the second thing, it's really wrapped up in that, is it a good stock? And I know we've said before, if you've had to use taxation to make something a good investment, then it's not a good investment.
Correct.
So to me, if you have to use a dividend to make a good investment, I put that in the same basket. So to me, the investment needs to stack up first, the direction of it, and is a good quality company, and is it going to be heading in the right direction? That's the first thing. If you don't do that, then regardless of the dividend, you're not going to do a very good job.
Yeah.
So that's more what I'm talking about. And then, if you get the dividend, it's the bonus. It's the bow on top of the cake.
Yeah, I mean, how would you like an investment that someone says to you, I'm going to pay you 5% per annum, but I'm going to take money off your investment,
I'm just going to keep
capital
taking money
over time.
And that's really what the industry want people to buy and hold. stocks that they don't want, basically.
Or it's just easier to manage clients if they're just doing that, isn't it?
Correct, absolutely. And I see financial advisors do that all the time, and a lot of people do. And I'm not being rude to financial advisors.
Because they look at their client and think the person doesn't have the knowledge to be able to make the decisions.
The same with brokers. The less I have to talk to my clients, the better. As long as they're trading, the less I have to talk to them.
So look, if you've got, you want more bigger and liquid stocks, there's a list of stocks there that pay good dividends
CBA,
at the top of the list.
Generally.
Yeah. Now, we can also go to the 300 or the top 100.
Yep.
So again, I've got it really small, and I should have come and seen Dr. Dale before I did this. But we've got a list of stocks here. Nice. Now, there's some really good growth stocks in there. Now, some of these dividends may not be there we go. FMG's at the top still. We're looking down there. Things like some of the property stocks from time to time are really good to have because they pay dividends 4 times a year often. You have to look that up, but often they'll pay at least twice a year, and they'll pay around the middle of the year. They'll pay a dividend, so you've got an interesting...
We've got Texas and vicinity centres there.
So they're interesting ones, but I'd more likely come down the list and go more to the market average. Don't be tempted to just sort of get something a bit higher. GPT's been a great stock, but it's pulling back at the moment. I think it will continue to be a great stock over time, but you've got other interesting stocks in there like GPT and Stockland, and not necessarily right now. You'd have to look at the charts to see when they're moving up, but there's a few of those that are moving in the right direction. So my thing, I guess part of the investing that we provide, we say stay away from insurance, pick some property, but right now property has been out of favour, but it's coming back, isn't it? Yeah, I know, probably just to help wrap this up a little bit is, I know when we say to people, would you prefer a growth portfolio, blue chip portfolio, 99% of the time they go growth. So it's sort of the same sort of mentality. Would you like high dividend yield or low dividend yield? And they go high dividend yield because they're thinking they're going to make more money, but it's not really. You're saying let's go for average dividend yield because it's sustainable. Yes. It's not a stock that's fallen away heavily and therefore the dividend yield's grown so much because it's a downward trend. Correct. But it's also not a growth stock that doesn't pay a dividend. So if you want a bit of a dividend in your portfolio and get that income, go for the middle of the road because they're generally likely to be growing but sustainable in their dividend yield. So that's what you're talking about, isn't it? That's what I'm talking about. Like the big infrastructure stocks are often good, but not right now because they've been pulling back. Once they get going, they will look good. So there's a timing thing to all this as well. So one of those big infrastructure stocks like a Sydney or TCL we like in particular, and that, but at the right time. Right now, it's not the right time. So that would be, I'd select one from a property to make the fourth and one from one of those big infrastructure stocks. All right. So in summary, always do your research, choose good quality companies with good earnings and have a process for selection to suit your portfolio. And above all, never buy a stock just for the dividend when you could be risking your capital. Now let's get into some more emails, shall we? But before we do, remember to hit that subscribe button now. Whilst you're there, give us a big thumbs up. I'm not going to do the thumbs up thing. I will. And click on the like button. Okay, we've got a question from Mikhail. Okay, we have a question from Mikhail who says, hi Dale and Janine. I'm starting your diploma on Monday, which we were doing yesterday. Looking forward. I also have read Dale's books, very informative. Could you have a look at Rio, please? Now it looks like the weekly chart trend line is broken and tested as well as a signal for entry. Well, that's interesting. He's using trend lines from my book. What do you reckon? Very good. Well done. So if we're looking at the stock, we can see that it's actually pushing up at the moment, but it's been, I think we talked about the miners on the show recently and how that pullback has really broken the momentum of the big miners temporarily at least. So I would like to see what it does in the next couple of weeks. Yeah, I can't see the trend line, so I'm not sure where he's talking about the trend line, unless he's talking about one last year. But, well, if he's talking about the trend, for the stock, how it was pushing down here, that could be a thought. That could be what he's talking about. Or it could be up here. You'll learn a lot of rules, Mikhail, on trend lines. Like, this is the difference between what's in my book and the course. There's 5 rules and trend lines in our course, and we actually write more words in the module for how to draw trend lines that are actually in the book. So all the distinctions. So whilst you've got an idea of how to draw a trend line in an easy way,
we give you a lot more detail and a lot more depth to it. So,
well, that's all on that one for now.
Okay. Now we have a question from Nick. He says, "Hi, Janine and Dale have purchased both of your books, but still have so many questions." Yeah, sometimes that brings you up more questions, doesn't it? You recommend buying the top 20 ASX stocks as popular ETFs that comprise mostly of the top 20 stocks based on size. How are the returns from individual stocks outperforming the ETF over the long term? Now, my understanding is that taking an active approach allows for you to sell any of these top 20 stocks should they reverse, whereas this is not possible in the ETF. Am I correct in my assumption? Thanks again, Nick.
Got all that up?
I'm getting hot.
I know, I'm giving you the big ones.
You're giving me the big ones. You are correct. You are very much correct, because the ETF has all 20 stocks, but your portfolio only is 8 to 12. So you don't need all 20, because in that top 20, you're going to find stocks that are going to go down. And I know Janine and I talked a little bit earlier when we're talking about dividends, is the big four banks were all going down for 5.5 years or more. So you wouldn't have had those in your portfolio, and yet all of those are in the top 20. I think 11 stocks in the top 20 are financial services, and there were some insurance ones. So you wouldn't have been able to, you would have managed to get a better return with 8 to 12 stocks in your portfolio of the top 20 than you would have had doing an index ETF, because yes, you would have been able to buy and sell.
I was going to see if you sunk or swam then, and you definitely swam.
Mate, I was doing the backstroke.
You did well. Life-saving came in handy, didn't it?
Yeah, it reminds me of a joke. But anyway.
Okay, thank you very much for that question. And we have a question from Chris. Hi, Dale and Janine. Dale, after reading both your books, I've been attempting to draw trend lines. Could you both have a look at GNX and see my attached images of trend lines I've drawn on both the weekly and monthly charts? Have I correctly drawn a downtrend line, which now looks to be broken? Additionally, the stock has a very high long-term debt. How do you factor that in when assessing fundamentals? I don't own the stock, but bought it on a proper game, paper game at 19 cents in October, maybe a little too early, as the broken trend line was not confirmed, Chris. All right, so, I mean, it just looks nice, doesn't it? But even it's nice. A liquid as anything, but from even the monthly chart, it looks like it's moving up nicely. So he said he bought it at 19 cents down there. Not sure
I can't see a trend line at all. So
it just depends where he's drawn his trend line and how he's drawn it.
I can't see a trend line on anywhere through here, because he said 19 cents before the trend line was confirmed. There's no trend line down there.
Yeah, I think when you're trying to draw trend lines, like Dale said before, there's so many little rules in trend lines, and people often just try to draw a line across, the whole move down, and sometimes that's just totally incorrect. And also, I'm not saying that he's incorrect, because we don't actually have his chart here to do a comparison and look at. But if we push. It depends what date he bought it at. Did he say it was October?
Yeah, he said 19 cents roughly before the trend line was really confirmed. Well, there's no trend line down there.
Yeah, so I don't know what he's. It was actually in a decline at the time. It was pushing back down, and it had gapped right down at the time. So
it was just high risk. But again, with trend lines,
unless he's done that on the monthly,
trend lines don't work as well on some of these really, really low cap stocks, because it's about. Trend lines are momentum indicators. They measure how much momentum a stock has or hasn't got, basically, whether the momentum's up or down. And so looking at it on lower liquid stocks, they're going to be less accurate. There are other tools you could be using, and it's always about square pegs for square holes. So whilst we teach you trend lines in my book, but I also teach it on monthly charts, and we bring trend lines down onto weekly charts through our courses and everything else. But the bigger the time frame being monthly charts, the easier it is to draw trend lines. There really are only 2 rules to draw a trend line on a monthly chart, which are in my book. And I don't teach anymore. But you've still got to have rules
about when to actually go in. So that's a separate issue, isn't
Correct.
it? It's drawing it, and then you've actually got to have the rule to get in.
Yeah, it's the drawing it, confirming it, the trend line, and then confirming the entry into the stock. And you don't buy before you confirm the entry. But it's great you're paper trading it, so you are learning. So
fantastic that he's having a go.
Yeah, I think it's great, and thank you for putting that question in. Now we have an email from Graham who says, "Hi Dale, I was wondering what your medium-term or 12 months outlook is on CPU or computer share. I've set my buy price at $15.31 with a stop loss at $13.85. It looks set to continue to rise nicely to around $18. The uptrend would be long confirmed by that point. I pause because perhaps now it is more risky a time to enter because we're probably going to see a slowdown or fall before the end of March in the ASX. Very well thought of question, isn't it?
It is. And look,
I think I'll give him the gold
reporting.
star for today.
It's reporting season as well. And often you can get a bit of a surprise during reporting season. But at the moment, it's just trading sideways, really. So until there's some direction, either up or down, then we won't really know. But sometimes the shares can pull back temporarily and then start to push back up again when they have these sideways moves.
But if it breaks up, I wouldn't disagree with him that it's heading towards $18. If it breaks upwards, if it breaks downwards, it's not obviously heading towards $18.
But it might just be part of an overall sideways move.
He hasn't bought in, so his
sideways.
buy price is 15. I think he said 15.80 or something. So probably.
Did he say what his exit was?
His exit was $13 something, somewhere down around about
his
where my
initial
pointer
stop loss?
is. His stop loss. But
Right.
again, once you've entered, Graham, you need to reset your stop loss based on your entry price. So, whatever. If you're using 15%, then it'll be 15% of your entry price.
Oh, you're talking about as to where the rule triggers versus what the actual price you're able to buy the stock.
Correct.
I think most people would just be saying that you're talking about whatever they bought it on.
Yes, but he hasn't bought it yet. So he's looking at, I'm assuming if he's looking at buying, I do like this at the moment. And as I said, if it goes up, I think you're right, I probably would go to $18. But that's everything on CPU right now.
Hi, Janine and Dale. And he's put your names in brackets. That's funny.
Because I'm special.
I'm considering buying BXB Brambles and would appreciate your analysis. I think it may be turning from a long-term downtrend. My monthly entry would be triggered if it trades above 11.31. You've said that for the market to be bullish, industrials need to turn around. Could this be the start? That's what I'm hoping. Caleb. Good on you, Caleb. All right, so we're looking at Brambles. I just think Brambles looks a little bit iffy from a long-term perspective. So let's just have a look at it here. It's tried so many times to break higher and it continues to have these big falls down. And so we've seen the one during COVID. Now there's a possibility if it goes through about 11.20 that it might rise for a while, but then it's a question of, well, how far is it going to rise? So it might be an opportunity for a good short-term trade if it does do that. But still, at the moment, the risk is to the downside, wouldn't you say?
Yeah, I'm agreeing with you. It's sort of, when you said iffy, I thought that's exactly the word I was thinking. So maybe I'm very psychic. Psychic. You know what I mean?
Cyclic.
I'm not your sidekick.
Well, you are, according to Caleb, because he put you in brackets.
Well, yeah, that's because I needed the brackets. Sometimes you put me in inverted commas all the time, don't that sort of stuff. But anyway, I'm agreeing with you. I think right now it's a bit iffy. Probably, if you said to me, is it going to go up or down, pick a direction, I'd say down. That would be, but I'm not.
But what you're saying is, in a nutshell, because I can read your mind too, is if it goes through this low here, then it's definitely going down.
But that's the question, isn't it? A lot of people ask. It's like, well, hang on, Dale, you said it was bearish. Well, I mean, that was what I'm seeing right now. But I have rules around if it goes up and rules if it goes down. And some people go, well, you take a two-way bet. And I go, well, you have to.
Yeah, because if it goes up above a certain level, then you're saying that strategy A or forecast A is coming up. But if it goes below Y, then all of a sudden the opposite's going to occur.
It's not driving a car where I'll control the steering wheel and the accelerator and the brake.
Flexible.
When the car moves, I've got to get on it or get off it, one of the two.
It's a good thing you've been doing your exercises lately.
I have. I'm losing weight. My shirts are getting too big.
I was going to say that.
I used to be a 38, then I went to a 39. Now I think I'm going to a 32.
So we're going to see you shrink like a balloon, is that it?
Cool. That's it for Brambles. Now let's get into our next question, which is from Gary, who says, hi, Dale and Janine. Bought Vocus. I love Vocus. Around $4.10, and with the recent takeover news, I was very pleased to see the share rising above $5, though it closed slightly lower towards the end of the day. Do you foresee it continue to rise, at least close above the takeover price of $5.50 per share or beyond? That was an interesting stock, wasn't it?
Wasn't it?
I don't know how many times I've analysed it for our students way back.
But the problem with it is liquidity is quite different, isn't it, to what it was some time ago. And the ASX have rules, particularly with us, with the direct equity managed account service, that we can only buy over 2 days now at an institutional level, where we used to be able to trade over 3.
Yeah.
So, that can present challenges for stocks like this. But this one, it's just gapped up on news, so you might not get the joy of being able to analyse it in future.
Yeah, but it's struggled. I mean, I know back through here I was doing some work with our traders and we were analysing this stock, and we took a big trade through here with our students on the recordings that we do. We actually took 2 trades through here and got out, and this is when the other takeover bids, there was like 2 or 3 takeover bids that failed, and this is why it moved up and then fall away. And then it moved up and fell away.
If you were talking to the board, would you say to them that this is too opportunistic and to let it go?
Correct. That's what I do. Vocus is a great company, and I think it's worth more than this.
I know my favourite thing to
really
do
do
is to talk about these stocks, and I think you should be talking about this one in the media somewhere and just saying that you think it's worth more based on analysis.
It's not about what's good for the directors, it's what's good for this company. And this company is a good company I've been watching for quite a long time. And as I said, we've made money out of this before a few times, but it's already gapped. So if you're not in it at the moment, and if the takeover bid is at $5.50, there's only roughly 30 cents in that at the moment. So it's not likely to move too much more. But if you're in it already and the board say, no, we don't want to accept the deal. I haven't even looked at the deal, so I don't really know in essence what I'm talking about, what the deal is, but I'm assuming 550 is based on the question. But if the board reject it, it's going to fall out of bed, go back down to, around to that sort of $4 sort of again. Temporarily, but it keeps hovering around that sort of $3, $4. So, but right now, let's see what happens, and maybe we can follow it in a few weeks' time and see what's going on with it.
Yep.
Okay.
All right. We have a question from Jason. Hi, guys. Loving the show and the podcast. Thank you for that. Wondering if you can give some insight into the relation to bond yield rises causing stock market sell-offs. Seem to be hearing a lot about it lately, says Jason. So, look, the bond market's an interesting thing, isn't it?
Yeah, I've had a few questions lately about the bond market, which means it's in the media. And generally when I start getting questions on YouTube or the emails coming in, there's news going out there about something, whether it was GameStop last week or whatever it is, or and I've had a few questions around the bond market. And
Doesn't that mean that the big end of town are trying to push it though?
Well, the bond market's really important. The bond market is much bigger than the actual share market or stock market, and the bond market or the cash market, probably put a big umbrella, the cash market trades like the stock market, and it's about the risk-free rate of return. And if the big end of town, and I'm talking about the big trillions of dollars investors, if they can get a guaranteed return of X, why would they have their money at risk in a stock market when they can get this, which is capital guaranteed or risk-free in terms of it? So when bond yields are going up, and it's about the difference between short, medium and long-term bond yields. So short-term bond yields tend to be a little bit higher than the longer term ones, because obviously it's very close to the expiry date of those bonds. So, but looking at the relationship between the short, medium and long term bond yields can help you understand where the big end of town think the market's going to go. And I think that's why it's really important. And you can get into a whole lot of economic arguments about it all. And I've sat there with bankers, high up CEOs, bankers, and they've just spun the head off my shoulders so many times. It's not funny talking about the bond market and the cash market. And I'm going, holy moly, it's really a complex area. So how do we bring it down for investors? That's the question.
Look, I think it's like anything. You've got to do your research for one, and you've got to be thinking about, well, does this really concern me? One of the signs it can be is that it's all about the money flow. So money could flow out of the stock market.
Correct. Into bonds.
Into bonds. But it's huge in the US, much more so than here. So if it's going to have an effect, it's going to have more of an effect on the US market, in my opinion, than anywhere else.
But with stimulus packages, etc., it's going to go to the stock market. So if the $1.9 trillion stimulus package all gets done, it's going to go to the stock market. So, and I'm thinking the bond yields at the moment with the big end of town, the long-term ones are suggesting the economic growth will be there in the stock market. That's what I'm thinking. On the surface, I may be proven wrong, but that's what I'm thinking at the moment.
Yeah, I think
so. I don't think you're really too worried about it. But anyway, the next question we have is, we've got a lot of questions tonight. The next one we've got is from Kevin, who says, hi, Dale and Janine. My question is about A2 milk and your thoughts. It closed at $10.23 on the 8th of February, has a yearly low of $9.93 and a high of $20.05, and I'm interested in purchasing the stock, but I see a lot of their long-term management resigning and the company's heavy reliance on China. Now, it doesn't seem to be pushing back and getting resistance to break above $11. Would love to hear your analysis. Generally, when the doom is so big, that means buy.
Well, it's close to the bottom anyway.
It's close to the bottom. Like I remember when Aristocrat, they had no board or no CEO and everything else, and they were such a low price, and then they went up 300 or 400% in the next 12, 18 months. Yeah. It was just, like Buffett says, buying doom, selling boom. Not saying that, haven't looked at the chart. What's your thoughts?
Well, look, looking at this one, we're at a really important level on the stock right now. So we could see it start to move up from there. Well, you can show them if you like.
You can put your finger on the mouse. You're allowed to.
Jeez, I'm allowed to.
It's not...
I've got to put the crosshair on, and you don't like me doing that. All right, so look, right now we can see there's a low here, which was likely to provide a bit of resistance, and there's previous resistance across here in August 2018, but it's found support from this move here. So it's actually, it could go down a little bit more just to test that support, and at the moment we're not seeing any evidence of it going up. So that's what we've got to wait for. What Dale was saying before about waiting to see the direction. If it goes up, then we have a theory about how high it might be able to run to. If it keeps falling, we know where it's more likely to fall to if it does. And look, if it does keep falling below this level that I'm marking around 9.50, then it could head all the way to between at least $7 or $8, which we don't want to see it happen, but it's always a possibility. If it starts heading up strongly above $11, we could see it go the other way.
Yeah, I think what we need to say to people is Janine and I have stocks that we own, and we have a watch list. And our watch list gets filtered all the time between what we're going to buy, maybe buy in the next month or 2 months, what we may be buying in the next 3 to 6 months. And we filter those. And some of the stocks we're thinking about buying in the next month, we just take them off because they don't do what we might want them to do to confirm that they're going up. This one's on my watch list for me personally, but I don't have it on, I'm going to buy it in the next month. It may be 2 or 3 months down the track. It may be never, well, maybe not be never, but maybe not for 12 or 18 months, but it's giving me a lot of interest right now, enough to watch it. I'm not saying buy this stock, I'm just saying we need to just keep it on our watch list. We definitely
need to keep an eye on it.
It's interesting right now. So, but anyway, that's it for our take on A2 milk. So
now, unfortunately, we've come to the end of the show tonight, and we hope that you've enjoyed the show, and we look forward to bringing you all of the hot topics related to trading and the market this year. Feel free to make suggestions on future topics, please, because that'll get him off my case. We thank you for participating, and remember, if you need any support and have questions about our courses, don't let your questions go unanswered. You can call our office on 1300 858 272 or email us at info@wealthwithin.com.au, and people will look after you.
Also remember to hit that subscribe button and like the video. Please stick your thumbs up video, and be sure to put this show on your calendar for next week, as we'll be right here on YouTube Live every single Tuesday 7 to 8 p.m.
Now, if you'd like to have your question answered on the show, either send your question in an email to info@wealthwithin.com.au, type Wealth Within Live in the subject line. Now, you must do this before 3 p.m. on Tuesdays to get into that night show, or really beg strongly. And if you have a topic that you would like us to discuss, send in your ideas, and we'll have a look at your requests for upcoming shows. Yeah. We're always doing that, aren't we?
Chocolate and bourbon works really, really well. Chocolate for bourbon.
Do you like
for me.
bourbon? Okay.
Yeah. As always,
Mark, isn't it?
Cool. As always, thanks for joining us, and we hope you have another fantastic week. We look forward to having you joining us again next week for our show. But for now, goodbye, good luck, and good trading.
Bye for now.
Yeah, I do like bourbon. Lots of it. No.